Hi friends, welcome to my YouTube channel InvestDad. My name is Joseph. The market has been extremely volatile in the last few weeks, especially for folks with heavy concentration in high-growth tech stock and Chinese ADRs. In this video, I'm going to review my portfolio and share with you how I'm rebalancing it so I can laser focus on the future trends to ride out these turbulent times. I'm putting the work in, so hopefully that will help you reduce your own research. Let's get started. Let's dive right into my portfolio. I have divided all of my holdings into 7 investing categories. Categories like EV and lithium battery technologies, digital wallet, gaming, and Asian tech growth, which I believe will significantly outperform the overall market within the next 5 to 10 years. So I'm slowly pouring money into these sectors accordingly. But as you can see, 21% of my holdings are currently in dividend income stocks and 45% in cash reserve. This is to make sure I can safely preserve a decent portion of my last year's gains. It will also allow me enough liquidity to accumulate attractive investment as they appear in the future. The amount of cash you hold in your portfolio mostly depends on your own risk tolerances and age. My investment methods may not be suitable to everyone, since everyone's situation is unique. So be sure to do your own due diligence and invest wisely. Alright, let's quickly explain my investment thesis per each category. For the EV and lithium battery categories, I currently own an ETF called LIT and LEO. LIT is short for Global X Lithium and Battery Tech ETF, ticker symbol LIT. Its top 10 holdings are on screen. You'll find familiar names like Tesla, BYD, Panasonic, LG, Samsung, and their corresponding sector they belong in from this graphic. CATL, Samsung SDI, and LG Chemicals dominates the lithium battery and modules maker market worldwide. Since I am personally too chicken little to invest directly into Tesla shares, by need, let me own Tesla shares indirectly. I have created a detailed LIT video with lots of useful information previously that you can find in my YouTube channel. I have discovered owning LIT is like investing into the future of lithium battery technology, EV, and autonomous driving. LEO, many refer it as the Tesla of China. I have been trading since its IPO at $9. I have sold all my shares at around $57 previously and recently bought share back in at the mid-30s. I'm bullish on LEO based on its unique battery swapping technology and its focus on the higher-end EV market in China. Also, the non-questionable support it will receive from the Chinese government as the brightest local Chinese EV manufacturer in China. You can also find a standalone LEO video within my YouTube channel if you wish to learn more. If you haven't already, please hit the like button, subscribe to the channel, and turn on the notification bell. It will be very important support for this channel, so I can keep creating new videos in the future. For digital wallet and cashless future, I own IPOE and PayPal. IPOE is a SPAC, short for Special Purpose Acquisition Company. SPAC is a fast way for private companies to go public without going through all of the complicated IPO processes. The merger between IPOE and social finance will soon happen. IPOE will then automatically switch to trade with the new ticker symbol SOFI within the public market. Obviously, we won't have enough time to go into details for all of my holdings. But based on my own research, and especially after the recent announcement from JP Morgan Chase Bank that they are canceling their Chase Quick Pay service and exit from the digital wallet market entirely. That gave us a pretty good idea that perhaps big banks just don't have the necessary DNA to dominate the digital wallet markets. I personally believe the cashless future will be dominated by three players: Square, PayPal, and SoFi. I'm currently waiting for Square to go under $200 before I pull the triggers. For Square, I need a bigger margin of safety due to the additional risk of its Bitcoin activities. I am, however, very bullish on Square in the long run. Next is gaming. Nintendo and its IP shouldn't be unfamiliar to anyone, like Super Mario, Zelda, and Pokemon. Just look at the younger generation, and we shouldn't need any explanation on why I am bullish in the future of gaming. I really like the direction where Nintendo, take a simple NTDOY, is heading, with its newly added online subscription models. Plus, it is finally cashing in on its famous IP with the launch of Super Nintendo World in Japan, and later launching in the rest of the world. Nintendo is currently trading as a Japanese OTC, over-the-counter stocks. That means it is not directly trading within the major US index, and therefore typically trades with lower volumes. When trading OTC stocks, I highly recommend only using limited price orders. Next up is Huya. Take a simple HUYA. We cannot talk about Huya without talking about Tencent and Douyu. Tencent is by far the largest player in the global gaming industry. Tencent has investments in companies like Riot Games, Epic Games, Ubisoft, Activision, and much more. And as you can see, it is also the majority shareholders of Huya and Douyu. Together, they dominate the Chinese gaming market currently. You'll see later I have indirect ownership of Tencent through CQQQ and KWEB ETF as well. For Asian growth, I mainly put my focus on China, Japan, and Korea currently. I also wish to invest in Sea Limited from Singapore, take a simple SE, but its current share price is a little too rich for my liking. For this category, instead of investing in individual stocks, I decided to invest mostly in ETF or private equity firms to minimize the trouble and any risk of delisting. Due to the political risk and your own preferences, you may choose to skip directly to the next category if this is not your cup of tea. There are plenty of other investment options out there, but for me, not investing into Asian stock market now while the price is diving will be a waste of opportunity. The two ETFs I owned are CQQQ and KWEB. You can see Invesco China Technology ETF, take a simple CQQQ's top 10 holdings on screen. This will surely give you a diversified portfolio with the largest technology company from China except Alibaba. Take a simple BABA. And that is why I also invest in KWEB, Kingshare CSI China Internet ETF. On screen is the top 10 holdings of KWEB. In the second line is Alibaba, one of the dominant force of e-commerce, cloud computing, and digital wallet in Asia. You're going to see duplicated holdings like Tencent, Meituan, and Baidu as in CQQQ. So we must keep that in mind in terms of asset allocations. KWEB also let you own other excellent tech companies like JD, Pinduoduo, and Bilibili from China. Next, SoftBank, a private equity firm in Japan, my investment into the Japanese economy, and much more. SoftBank owns a local Japanese bank and telecom company, but Alibaba is by far one of its largest holdings, taking up 52% of its total equity value. SoftBank currently owns 21.8% of Alibaba's shares. I'm very bullish on the future of Alibaba. Even with all the negative news recently from China, namely its trouble with its Ant Financial division. Baba currently trades at a very reasonable PE ratio. Its potential in its Asian cloud computing market, its solid e-commerce ecosystem, makes it a must-own stock for anyone's portfolio in my opinion. But that's not all. SoftBank also owns Arm, has majority holdings on Coupang, Amazon of Korea, and minority holdings on OpenTalk and Breitbart, the largest online and offline real estate player in China. 17 Education and Tech Group, take a simple YQ, is one of my more speculative picks within my portfolio. The company provides a smart in-school classroom solutions that delivers data-driven teaching, learning, and assessment products to teachers, students, and parents, covering over 70,000 K-12 schools in the first half of 2020. YQ's share price got hammered in the last 3 weeks, as you can see in this chart. I started to invest in this company when it is in its low 11, and slowly averaging down to my current cost average of $7.49. Its original IPO price is around $10. At the current share price, I believe it is way undervalued and worth holding for the long term. Next, Mr. Warren Buffett, the iconic symbol of value investing. And the category we are talking about here is US economy recovery. Berkshire Hathaway, ticker symbol BRKB, is much more than just value investing. It outright owns Geico, BNSF, Fruit of the Loop, and a bunch of energy companies spreading across the entire US. When the US economy recovers, this holding will certainly benefit greatly. In Berkshire's stock investment portfolio, Apple stock, ticker symbol AAPL, takes up 42.2% of its holdings. Other worthwhile stock investment includes Bank of America, Coca-Cola, Kraft, Verizon, and Snowflake Inc. Value investing is not that, my friend. Next up, XLI ETF, Industrial Select Sector Spider Fund. Its top 10 holdings includes brand names such as Honeywell, Union Pacific, Caterpillar, UPS, Boeing, GE, and Deere & Company, which are all household names in America. Next up is a company called Smile Direct Corp, ticker symbol SDC, a pioneer for digitalizing the teeth strain process in the dentistry world. I believe its focus on bringing the most cost-effective and trouble-free way for its customer has an extremely bright future. Another reason I invest in SDC is for its international expansion plan that we cannot underestimate. My 4 dividend holdings should not be unfamiliar to any dividend income investors. First up, AbbVie, ticker symbol ABBV. This is one of the very few stocks that I still hold since March of last year. I'm currently up 48.55% with this one, and it is paying me well over 5% of dividend annually when I bought it at $71.34 per share last year. At that time, investor was very worried about its biggest blockbuster drugs, Humira, losing his patent status. AbbVie has since proven to its investor that its upcoming drug pipelines can more than fill its financial gap going forward. Second is a famous monthly dividend paying REIT, Realty Income Corp, ticker symbol O. Its well-diversified real estate holdings and triple net structures proved it to be rock solid even through the toughest time of the pandemic. Investors love its monthly dividend payment, and so do I. Thirdly, AT&T, a love or hate stocks. The naysayer will immediately attack its large debt and lacking management team. I picked it up at around $28 per share, when no one was giving it any love. I'm willing to give the new CEO time to prove himself, and am optimistic with its HBO Max and 5G initiatives. While I'm waiting, the 7% dividend makes T serve almost as a bond holding in my portfolio. Last but certainly not least, waste management. I love its non-cynical business model and stable dividend growth. I bought it at $109 and have no complaint. Folks, that's a lot of information we just sift through. If you're still with me, that makes you a true fan. So don't forget to hit the like button, subscribe to the channel, and turn on the notification bell so you won't miss any upcoming video in the future. Thank you for watching and happy investing. Hope to see you soon. Goodbye.